These are 3 stocks that you should be buying right now in June of 2025. And one of these stocks is a brand new addition to my portfolio today. And this video will explain why. And normally when the VIX is above 20, that means that the market is pricing in a lot of bad things to come. But that isn't always true. And most of the time the VIX will return to its average level of about 19. There are 1T pickup truck is my favorite looking truck on the market today. And I think that their future R2 SUV will be very popular when it comes out later this year. They delivered less vehicles than expected in both Q1 and Q2, which disappointed Wall Street analysts. First of all, the stock is currently trading below its book value, which is rare for a growing company like this. Secondly, analysts are expecting earnings to grow by over 50% per year over the next 3 years. And even if you don't like their products, you still have to respect their brand. What's even more impressive is that Nike's digital sales were up by 12%. They have partnered with a Chinese e-commerce platform called Tmall to offer personalized recommendations and exclusive products. But Nike has a plan to turn things around. And this seems to be working as orders on Tmall increased by over 10% in the last quarter. And when you zoom out on this chart, you can see that orders on Tmall have been increasing every single year since they partnered up. And when you look at this chart, you can see that digital sales make up a larger portion of their overall business each year. They're a leading e-commerce platform that helps small businesses build a website and sell their products online. And the reason for that is because they keep raising their prices. In fact, their latest earnings report showed that subscription revenue per merchant increased by 17% year over year, which is a great sign that they're able to pass on rising costs to consumers. This is when a company sells their products directly to the end user instead of going through a third-party retailer. And just last week, they launched a new service called Shopify Global, which will allow merchants to easily sell to international customers. And if you look at this chart, you can see that this is working as total payment volume is increasing every single year. They have a net profit margin of about 15%, which is very high for a tech company. And when you combine that with a strong balance sheet, it means that they have the ability to invest back into the business or acquire other companies. And this is another area where margins tend to be higher. And it's also trading at the 200-day moving average. And when a stock breaks through this level, it usually ends up consolidating around that level. If you enjoyed this video, please hit the like button and subscribe for more. Thank you guys so much for watching, and until next time. And this means that the stock could be in for a nice bounce here. These apps generate a significant amount of revenue for Shopify. In fact, about 40% of their total revenue comes from these third-party apps, which makes the business more resilient to economic downturns. In fact, Nike's gross margin from their DTC channel is 44% compared to just 36% from their wholesale channel. So the shift towards DTC is helping to improve Nike's overall margins. And this is a good thing because online sales are generally higher margin and they continue to gain market share. It's literally plastered everywhere you go. And even though people may mock the brand for being overly commercialized, it still doesn't stop people from buying their products. And when you have strong earnings growth like that, that usually leads to a higher stock price. Lastly, we must consider the valuation. When Rivian IPO'd in 2021, they had a valuation of $150 billion. It currently pays a dividend of 1.3%. Its forward price to sales ratio is at its lowest level in 5 years. And its forward price to earnings ratio is at its lowest level in 10 years. The only downside is that Nike is a very mature business and revenue growth is only expected to be around 4 to 5% per year over the next 5 years. But that's not really a big deal when the stock is this cheap. But after poor deliveries, that number crashed down to $36 billion. That's a 75% drop in valuation in just a couple of years. But today, Rivian is back up to $87 billion, which is right in the middle between its IPO valuation and its current valuation. And when you look at this chart, you can see that over time, the market cap tends to return to the mean. And when it does, that means that the stock price will have room to run. And this was mainly due to supply chain constraints. But the good news is that these issues have mostly been resolved, and just last week, Rivian announced that they have entered into a multi-year agreement with a new supplier for key components of their electric platform. This will allow them to ramp up production throughout the rest of 2025 and into 2026. And these new components will actually make the manufacturing process easier and cheaper, which should improve their bottom line. And when it does, that means that a lot of fear has been priced in. As we know, the month of May was not great for the stock market. The S&P 500 had its worst month since December of 2022 with a drop of over 6%. But the good news is that in the last 10 years, the stock market has only seen negative returns for 2 months. Which typically does correlate to a weaker stock market. We have already seen many of those fears priced in, which means it's a great opportunity for long-term investors to buy the dip. 2 months out of 240. So negative months happen from time to time. And even though the reason for the sell-off in May was due to rising bond yields, this allows them to receive a tax credit of up to $7.5 thousand per vehicle sold, which significantly helps increase their gross margins. And speaking of margins, Rivian is actually profitable, which is something that you can't say about many EV companies out there. In fact, their net profit margin is currently sitting at about 8%, which is around the same as Tesla. And that stock is Rivian. In fact, when you look at the VIX index, which is also known as the fear index, you can see that volatility is still very high. So here are 3 stocks that you might want to buy on the dip this June. And the first stock is a consumer discretionary company that saw its stock price drop by almost 30% from its peak earlier this year. Now, if you haven't heard of Rivian, they are an electric vehicle manufacturer who produces some of the best-looking electric trucks and SUVs. And because Rivian is a relatively new company, they're able to take advantage of the Inflation Reduction Act. But the reason why Rivian's stock price dropped so much this year was because of poor deliveries. And this is why I believe that Rivian could double in price over the next 12 months. Speaking of running, the second stock that you should be buying on the dip is Nike. And this one is a no-brainer. If you don't know anything about Nike, then you've probably been living under a rock. In fact, in the latest quarter, Nike sales were up by 7%, which is pretty impressive considering that the overall economy is in a recession and consumer spending is down across the board. The issue with Nike though is that their earnings have been declining mainly due to lower demand in China. Not only that, but Nike is also investing heavily into their DTC channel, which stands for direct to consumer. On top of all that, Nike stock is trading at a discount. Which brings us to our final stock, which is Shopify. And this is the one that I'm adding to my portfolio today. Now Shopify is another no-brainer. And even though Shopify is a mature business, earnings have been growing at a rate of 20% per year. It's currently trading at the same price that it was at during the pandemic. What's also great about Shopify is that they're expanding into new markets such as China. Another reason why I like Shopify is because they have a massive ecosystem of apps that help merchants do things like market their products, ship their orders, and accept payments. What's also great about Shopify is that they're very profitable. Lastly, Shopify stock is at a major support level. Overall, these are 3 stocks that you should be buying on the dip in June.